welcome and thank you all the Yes Bank leaders. And now I would also like to introduce them to you. Starting from my left, we have Ms. Shubha Rao, Senior President and Chief Economist, Economics Knowledge Banking. Mr. Pranay Mandal, Senior Group President, Branch and Retail Banking. Mr. Rajat Munga, Senior Group President and CFO. Mr. Jaydeep Iyer, Group President, Financial Management. Mr. Sanjay Palve, Senior Group President and Senior MD, Corporate Finance. And Ms. Namita Vikas, Senior President and Country Head, Responsible Banking. Like always, Mr. Rajat Munga will take you through the results and brief you about it. It will be followed with a Q&A session. And like always, we will request you to please restrict the questions only to the results. Any other queries you may have, our corporate banking team is here. They will be very happy to help you. I'm also pleased to inform you that this press conference is being streamed live over Twitter using Periscope app. Yes Bank is the first organization globally to live stream its annual results in collaboration with Twitter. Please follow our Twitter handle at Yes Bank for all the latest updates. Over to you, Mr. Mohan.
Good afternoon. A very warm welcome to all of you for Yes Bank's fourth quarter and for the full financial year 2015 results press conference. Before I get into the specifics of our results, I also want to take the opportunity to reflect on the fact that we have very successfully wrapped up our version 2.0 plan, the 5-year plan that we had announced closer to the month of April 2010 and which we completed in the month of March 2015. During these 5 years, the bank has transformed from a small sized bank to now a meaningful entrant in the what we can call the large bank category. The bank has grown multifold across several parameters, including network, the franchise, the human capital, its profitability, as well as the balance sheet size. Importantly, the bank's risk management ethos has been firmly evident in this period, which has helped the bank in navigating the economic slowdown, and the bank has shown very respectable outcomes of overall asset quality indicators that we have been publishing. Going further, in light of the now expected improvements in the economic environment, the bank has the branch network, the banking products, the human capital, all in place to transform itself into a corporate and a retail SME focused large bank. Few comments on the key economic developments that the bank has been witnessing of late, especially in the last quarter. We witnessed twin repo cuts of 25 basis points each, which has resulted in the cost of funds moderating in the economy. It has also resulted in a moderation in inflation concurrently to falling interest rates. We've also seen a very stable currency environment in the quarter gone by. We did witness the announcement of what we believe is a fairly progressive union budget with an enhanced focus on capital expenditure, a credible underlying arithmetic of the fiscal balance, a focused approach towards divestments, as well as a far higher degree of fiscal federalism that we witnessed in the union budget. We also saw the government keenly focused on various reforms. We witnessed the passage of key bills, including the insurance bill, the coal mines and minerals, as well as the build-out of transparency through successful electronic auction of coal mines, the telecom spectrum auctions. All of this, we believe, augurs very well for the economic outlook, and we believe that the foundation is being laid through these developments for a general uptick in the Indian economy. Coming to the financial highlights briefly for the quarter, we believe the bank has once again delivered a fairly strong quarter in terms of both growth as well as profitability. Concurrently, the bank has increased the granularity of its business and has maintained respectability on the various asset quality metrics. Let me focus on the advances growth in the current quarter. The bank has posted a fairly robust growth in advances of close to 35%, totaling now to a loan book of 75,550 crores as at March 31st, 2015. The bank witnessed fairly out of line credit growth, but reasonably diversified, and it was led by the retail and SME segments in this particular quarter. Also had an influence of the target completion of priority sector lending. This has resulted in the retail and SME book of the bank increasing its share in the advance book to close to 34% from a little over 31% as at December 31, 2014. Some comments on the deposit side as well. The bank witnessed a deposit growth of 23% during the current year. The deposit book now stands a little above 91,000 crores. Within the deposit books, the CASA and the retail deposits continue to outgrow the overall headline growth, resulted from the continued investments that the bank has been making in retail branches and including retail sales forces. In the current year, they now total to a little over 21,000 crores. The CASA ratio stands at 23.1%, which was at 22% same period last year. The total retail deposits, including CASA, now exceed half of the deposit book of the bank at 51.5%, and this is up from a number of 42% in the same period last year. Coming to the net profits for the current quarter, the bank has posted a pretty steady quarter, and we are reporting a 28.1% growth in our net profit after tax. And the reported number this quarter is 551.1 crores. This profit growth has been led by both growth in non-interest income as well as in the net interest income for the bank. The net interest income increased close to 36%. To a little short of 1,000 crores, and that's in line with the loan growth that I mentioned a bit earlier. The NII growth has also been benefiting from the increasing margins in the bank's loan book as well as the deposit book. We are reporting an expanded net interest margin of 3.2% for the full financial year. This compares with a number of 2.9% in the previous financial year. For the fourth quarter as well, we are reporting net interest margin of 3.2%, and it compares with the net interest margin of 3.0% for the corresponding quarter the previous year. Non-interest income also posted strong growth of 32.5% in line with balance sheet, and we are reporting a net interest income position of 590 crores for the current quarter. In terms of the return ratios that the bank has been delivering, this quarter also we are reporting an on-par return ratio performance as compared to the recent few quarters. The return on assets are being reported at 1.7% on an annualized basis, and the return on equity is being reported at 19.2% on an annualized basis. And the return on equity also factors an expansion of capital that the bank had conducted through a QIP issuance in the first quarter of the last financial year, 2015. We saw a small correction in our yield on advances in the current quarter. The yield on advances fell by about 20 basis points. Correspondingly, the cost of funds fell by 28 basis points. We've seen a slight expansion on the loan spreads, which have also benefited the net interest margins in the current quarter. Few comments on the asset quality position as well. We are pleased to share that the bank continues to show resilience on the asset quality parameters. Our gross NPA position is being reported at 41 basis points, that is 0.41%. The net NPA position is being reported at 12 basis points, at 0.12%, as at March 31st, 2015. Among the asset quality indicators during the current quarter, we would like to also highlight that the bank has not sold any NPAs to the asset reconstruction company companies in the current quarter, so there has been nil sale of NPS. We have had an increase in our restructured book though, which is a small increase from a position of 0.24% of restructured book now at 0.50%. So 50 basis points of the bank's loan book now stands restructured. And this change this quarter is represented largely by one single account, which was restructured due to delay in the commencement of commercial operations of the project. And this project continues to be in the eligible restructured category, which RBI has announced over the last couple of quarters. Even though this has been restructured before March 31st, it continues to be in the dispensation which RBI has given. We are also expecting that this particular exposure will be commercially commenced in terms of its operations in the next 3 to 6 months. The bank's specific loan loss provisioning coverage for this quarter is healthy at 72%. In the current quarter, the bank has taken total provisioning of 126 crores. That's higher than the corresponding quarter last year, but for good reasons. Among others, we have seen a sharp increase in the loan book, which attracts general loan loss provisioning. So about 40 crores of this provisioning for the current quarter is on account of general loan loss provisioning. We have stepped up on our countercyclical provisioning as we had reasonable buoyancy in our revenues in the current quarter. We now have about 50 basis points of our loans that we have taken in terms of countercyclical provisioning, and in this current quarter, about 50 crores went towards increasing our countercyclical provisioning, which is over and above any NPA or regulated provisioning. The capital position of the bank continues to be healthy. We are reporting a Tier 1 capital adequacy of 11.5% and a total capital adequacy of 15.6% as at March 31st, 2015. The total capital funds would be 16,151 crores as at March 31st, 2015. Some quick comments on some expansion initiatives that the bank will be planning in the near future. The board has today approved the setting up of an IBU, an international banking unit, in the GIFT city that the government is proposing, and the bank will approach the regulator suitably to get the necessary approvals. This IBU will allow the bank to establish operations to cater to the global requirements of Indian companies, and will also allow the bank the ability to access international markets for funding. Essentially, will further add to the corporate banking offering largely related to the Indian multinational companies. The bank has also taken an approval for more than an enabling approval for further capital raise of up to $1 billion through an equity issuance, which could be either through QIB, ADR, or GDR. This will also be further to the shareholders for their approval as well in the ensuing annual general meeting of the bank. The capital raise is to essentially enable the bank to be prepared for the growth opportunities that are being witnessed, and we believe will only increase in the next few quarters and years to come. In the current quarter, the bank also signed a very important MOU with the US government developmental finance institution called OPIC, which is OPIC, and along with Wells Fargo for financing small businesses in India up to a size of $220 million financing that OPIC will provide. And within this financing of $220 million, about $100 million would be used to support either micro SMEs or SMEs operating in underserved rural and underserved urban markets. The bank also continued to garner accolades from Indian and international as a testament to the bank's effective risk management, superior human capital, and commitment to innovation and technology. The bank won multiple accolades at the recently awarded Asian Bankers Award in Hong Kong. accolades included the best trade finance bank in India, the best corporate finance trade deal in India, the best cash management project in India, and the enterprise risk technology implementation of the year in India. Bank also received Excellence in Social Media Award and the Best Initiative in Financial Inclusion in the Retail Banker International in Singapore in the month of March 2015. That was a summary on our performance that we wanted to share with you, and we'll be happy to take questions.
So elaborate on the QIP is wondering about moving to raise $1 million. My first question is how much dilution will lead to, how much equity dilution will that lead to? Other than that, what is the kind of growth you said you were envisaging because you raised a huge amount of money? Where will it be deployed?
We, as you would have seen in the results, the growth that we are reporting is in the mid-30s across categories of loans, deposits, net interest income, non-interest income. The capital that we are planning to raise is at this moment only enabling approval. So it is not necessarily something that we are planning to launch in the immediacy of the situation. We still have plenty of capital. However, we have more confidence on growth as it is appearing. As you know, the banking sector dynamics are pretty complex. The economy is improving. So, in the situation that we are in, we think that the growth can come faster, and we have to prepare ourselves for the right resources that we need for growth. The dilution you can expect should not be more than 10%.
What's the time frame? What's the time frame to raise this?
You're looking to raise this. Could you share more details?
No, I want to highlight this is an enabling approval. We are not launching any transaction. It is a purely enabling approval. This will require shareholder approval. This will require regulatory approvals. We are just emphasizing the fact that there is the environment of growth is coming back. You look at our results. We are also showing that in our outcomes. And we have to be prepared for raising capital at the right time. We can't say whether this will happen in any terms of time frame. But since we are taking enabling approvals, we are mindful of the fact that growth will require capital to support it.
What's the kind of growth that you're looking at for this year? And also, is there a version 2.1 or something that you're planning for the next 5 years?
Well, yes, there will always be planning. So we are setting out a 2020 sort of thought process. I think we are working on calibrating the outcomes where growth should be ranging between 20 and 30% as far as the outcomes that you should be expecting from the bank. There is the desire for the bank to become now a meaningfully large bank and become relevant to both our borrowers as well as our depositors in the process. So the plan will be set out as what we can say is version 3.0, more than the version 2.1. It is basically to build, if I can summarize, the finest large bank in the country.
What do you define large? What is the asset size that you have? Or balance sheet size?
I would say relevant. I wouldn't say large. I think if you look at 20-30% growth, we are about little short of 1.5 lakh crore balance sheet. We should be by that CAGR. If you do the maths, we will be somewhere between 4 and 5 lakh crore balance sheet size.
By 2020.
By 2020.
So you recently ventured into international operations. So what is your vision on that front? You also opened a branch in UAE. So what is your vision on that international?
Yes. So we just to clarify on that point, we will be opening a representative office, not a branch, in the UAE. But what I was highlighting during my commentary on the results and developments was the interest the bank now has is in opening an international branch, but in India, which is what the government is enabling when they are setting up the GIFT City, where if the bank sets up a branch, it will be as if it's an international branch. It will be outside the controls of Indian exchange controls, which is the FEMA. We will not be able to lend in Indian rupees. It will be a dollarized business, and we will predominantly use that to service the requirements of Indian clients when they are venturing overseas.
So it will be for global funding, for their global operations.
Yes, for subsidiaries of Indian companies who are venturing to other countries in terms of their business expansion and need funding in major currencies. That's right.
Would you use the capital that you're looking to raise to fund any acquisitions? You were looking at an AMC. So would you look at funding any acquisitions in the coming months?
I mean, the capital will be used, I would say, substantially for growth. If there is an acquisition along the way, when you mentioned AMC will not be very capital intensive. So it cannot be the primary basis of planning new capital. The new capital is largely linked into our organic growth that we believe we can deliver here on.
You also recently launched green bonds basically 2 months back. So are you all planning to raise some more money, and you all got good response? So is the bank planning to raise some more money through that route?
Yes, the green bonds that we launched and we raised about 1,000 crores in the month of February and March 2015. The bond has been issued in the infrastructure bond category that the regulator has permitted. But the bank has chosen to take a step forward that while we are raising resources to on-lend to infrastructure, we would be on-lending these resources only to green projects, which are largely related to renewable energy, which will be predominantly in the solar and wind operating space. So while it is an infrastructure bond, it is being directed towards the green bond design, which means that it should be used. We will use it under green bond principles. We also plan to launch more in the infra bond category. There will be both green and non-green bonds in that category, and maybe as soon as first quarter of this fiscal, we should have some launch plans getting executed.
So what kind of money are you all planning to raise?
Well, we have an overall approval for all debt raising up to 7,000 crores. We have completed 1,000 crores, and it will be in that existing approval.
Sir, also you said that you will take.
You spoke about an IU, just a clarification on that. Will single exposure limits that you have for corporates also apply to any lending that you do via the IU, as any business you do via this?
Well, let's say not all guidelines are there in very clear terms, but my expectation is that they will apply. Yes.
Mr. Moga, can you give us a rough timeline for the share sale? Is it like more likely in the second half of the fiscal year, or is it possible in the next 6 months? Or 6 months.
How long is the approval valid?
Approval is not yet valid. Approval will become valid when the shareholders approve it, and the approval is valid from the AGM to the next AGM.
Right. So can we say in this particular year or next quarter, and not exactly direct time frame, but if you could give us
H1 or H2 of the fiscal year, more likely, when it is more likely?
See, I don't know that there is no specific answer to that. Because we haven't thought about the timelines. I have been highlighting that this is enabling approval. If the growth continues to be as robust, we will not have time to then plan and take all formalities and shareholder approvals at that time. So we are taking the approvals now. It could be that we will not raise capital. It could be that we will raise maybe as soon as the second half. But I don't think it is happening sooner than that.
So not in the first half of fiscal year?
There is no plan. If it was happening that soon, we should have had a very tangible plan.
Question on the restructure, you said most of it from one chunky account. You mentioned the sector that was
It was in the road sector.
road
So
sector.
it's a road project which is about 80% complete. However, it is past the dispensation that is available for commencement of operation in terms of time.
What is the total exposure of that?
Maybe about 20 basis points of the loans. It will be about 160 crores.
You've also seen that retail credit has the exposure to, the proportion of retail credit has grown to 35%. Where do you see the mix in the coming year as the retail versus corporate?
So let's say the 2020 picture that we were building should also give us about a 50-50 mix, where the first 50 would be retail and SME, and the second 50 would be large and mid corporates.
This rise in retail is largely for the PSL unit, or is it the housing and the study?
Both, because the PSL is also entirely more and more retail than what it already is. So there is a fairly high overlap. What our retail outcomes are, we are lending to more commercial-oriented retail borrowers. So we are lending for businesses, for micro borrowers, for commercial equipments, for machinery, SMEs, micro SMEs. We are not as deep down in consumer lending. So we are not doing car loans. We are doing car loans, but our share of consumer loans is about 20% within the overall retail and SME pie, if we can say. So the growth has come from largely the commercial retail and the commercial SME lending business that we have been doing.
So you spoke about 28 basis point fall in cost of funds, but your NIMs have remained flat on quarterly basis. What's the reason for it? Because last time you had mentioned that you're carrying high quality liquid assets for LCR, and your LCR is also much higher than the regulatory requirement. So is that the reason for your flat NIMs?
Well, flat NIMs, if you look at how NIMs are computed, they also have that it utilizes both cost of funds and equity as the funding sources. So as the bank grows, equity is not growing because you raise equity once in a while. So as the bank grows, you are funding more from deposits, less from equity. So while your spreads are increasing, but margins are not. So the leverage effect pulls the margins lower by default. And then as our spreads are expanding, that is compensating the leverage effect. And besides, like you mentioned correctly, we continue to hold high quality liquid assets for the requirements which have now been inducted in the LCR regime. And we would be, RBI requires us to keep about 60% of the requirements in liquid holdings. We are keeping about 80-90%, so more than 60. So about 80-90% of the holdings are being maintained in HQLA. That what is stipulated. So 60 stipulated, 80 and 90 is what we are maintaining.
And also the base rate cut, is there anything planned for the base rate cuts?
Well, there will be a base rate cut, but there is nothing which I can confirm that is happening as of today. We do have a trade-off to come because we are also witnessing fairly, I would say, significant growth in the loan book. So you can see the loan book is growing close to 35%. I don't think we can add another steroid to this growth at this point in time. So we are weighing it with the emerging opportunities.
And last question on the treasury performance, especially on the derivatives side. Throw some light on that.
I'm sorry, the performance on
Treasury book.
the treasury book is we're talking about FX or
The FX and bonds.
So the book is being led by foreign exchange businesses largely. So we, as our clients are transacting on imports and exports, we are helping them hedge convert their currencies from dollar to rupee and vice versa. So that gives us commissions and margins. So that is doing pretty well. And you will see there is growth in this quarter as well.
How is your foray into the home loan space?
Yeah, so
The government playing on the DSL side.
well, if you can.
Yeah, as I said last time, it's the early days, but it's picking up pretty well because in terms of we are primarily selling through our branches, and as the customer franchise increases, we continue to grow. So some of the businesses which is in the both in the commercial mortgage space as well as in the personal mortgage space, things are picking up pretty well. But home loans obviously will grow gradually because it's a fundamentally a long-term strategy.
Now, what you say? 10,000 crore you're going to raise bonds. That's the president. You have mentioned 10,000 crores you're going to raise to bonds, infra bonds. Have you raised any infra bonds last fiscal?
Yes, we did one tranche of 1,000 crores. The green bond that we were discussing is actually under the infra bond category. It's just that it is not financing any infrastructure, it is financing only renewable energy infrastructure. So that's been carved out.
And this 10,000 crore, what's the plan on this?
Well, near-term plan, let's say we would expect that we will execute about this over the remaining 12 months. So our pace would be doing about between 1 and 2,000 every quarter. And we should be you have to give us maybe 2 to 3 weeks. We should be also planning to launch our next round of infrastructure orders.
How long do you think you'll be able to maintain 6 to 7% rate on the savings management process? And do you think that's coming in the way of these high cost?
So base rate cuts this will not come in the way of base rate cut. Base rate cuts are largely driven by time deposit costs that we are seeing. So we have not cut our time deposit costs particularly sharply either, because you can see most banks have only tweaked with their either deposit structures or their let's say base rates. So the thinking on the savings account is pretty much the same. We don't see that there is any reason to change the 6-7%. What we are doing is calibrating the mix between 6 and 7%. So let's say beginning 1st April of this month, we have increased the threshold for the 7% let's say category, where now depositors who will be earning more than 300,000 rupees in their savings accounts will be eligible for 7%. So we are just calibrating the mix of these two buckets of pricing, while we are also hoping and are also delivering a fairly significant growth on the underlying SABOK as such. The SABOK you will see has increased 35% over the last year. It's now almost between close to 12,500 crores in terms of the SABOK. And before deregulation, this book was 800 crores. So in the last 3.5 years or so, we have seen about a 15-fold increase in the savings account balances. So the pricing strategy continues to be the same. The some calibration will be always in order.
Steel companies, some of which are highly leveraged.
Yes.
Could you just quantify the amount of exposure you have to steel, power, and infrastructure?
Yeah, so we have about 3.2% exposure to steel, and that report, since you asked, I must mention, is actually under research. The information there is not accurate. So we'll be happy to use this opportunity to share our position on the steel sector. So you mentioned 3.2% is our total book. Out of that, about 2/3 is AA plus or better rated. So if you size these numbers, the book will be between 2.5 and 3,000 crores, and out of which at least 2,000 crores is AA plus or better. So the cause and effect and conclusions are actually pretty unfair to the data that you can also see from our disclosures. But that's someone's view. We can really influence them so much. But steel sector is not a risk item that we would be highlighting, given the facts that I'm supposed to.
So you're not worried about your exposure?
No, not at all.
What about power?
On power, we have about 1.7% exposure that you can relate to power sector, which is, let's say, project finance. And again, largely, I would say more than 2/3, possibly 80% will be renewable energy. This will be wind and the solar sector projects that we have financed. I think we have only one single small exposure to a thermal project finance. So project financing to a power plant which is under construction and is coal-based thermal power project. I think there is only a single exposure, which is about 15-20 basis points of a loan book. And not a worry. And I mentioned we have the other infrastructure exposure that is relevant would be roads, and we have about 1.3% of the bank's loan book is exposed to roads.
Have you zeroed in on any AMC players you're looking at?
Our default plan would be to set up an AMC of our own, and we are under the approval application process with the regulators. So it's a little early to begin to suggest on that side. So our default plan is to set up one by ourselves. While along to talk to any current promoters of AMCs who are looking to exit. We will be happy to have that conversation also.
We have time for one more question. Anyone has a question?
Well, there were 3 accounts restructured, but 90% of the value was one account.
Any questions?
Just a sense of your asset quality, sorry, going forward, given that a lot of restructuring has happened in the last quarter, do you see that happening in the coming few quarters as well?
Let's say we have a total restructured book, if you see, of 50 basis points. That's a lifetime restructuring. So I would not want you to conclude that a lot of restructuring has been happening at least in our context. Maybe some numbers that you see from other banks have far higher numbers. So I think our asset quality, in terms of your question, how we will look at asset quality in the next year will be in line with last year. Broadly speaking, if I have to, let's say, generalize, whether that will manifest in NPAs or restructuring or any other form of, let's say, asset quality indicator is not something that we can perfectly predict. But we know that our book has been through a fair amount of seasoning and grinding in the last 2-3 years, given the economic slowdown. And you see our results. We are a 42 basis point gross NPA and a 12 basis point net NPA position. We are a 50 basis point restructured asset position. I must mention here that we also, besides general loan loss provisioning, which you will know is 40 basis points for all loans, specific NPA provisioning, which we have mentioned, we have already provided 72% of our NPAs. We also have another 50 basis points to loans of counter-cyclical provisioning. So we have taken about 300-400 crores of provisioning, which we are not required to take as per our current asset quality outcomes. So this is also a buffer that we have built in terms of as a prudent practice. I mean, you would always like to see a balance sheet which has rainy day provisioning. So it is, for all this put together, I wanted to sort of give that rough indication that fiscal 15-16 will look like similar to fiscal 14-15 on our asset quality indicators, and which continue to be healthy.
All right, thank you so much for attending the press conference. Mr. Moka will now do the TV business. Any other queries you have, please, I request you to take them up.
Thank you very much.